What if I told you there are 5 stocks in this market right now that all connect to the same major trend, but the risk-reward is completely different for each one? Some are high-quality businesses. Some are speculative. Some are too expensive today, but worth watching on a pullback. And by the end of this video, I'm going to rank all 5 from least attractive to most attractive. The 5 stocks are Walmart, Costco, Lululemon, Eli Lilly, and Insulet. And this is not a casual watch list. Every stock on this list plays a different role in what I think is one of the most important market themes right now, the K-shaped consumer economy. On one side, you have the pressure consumer. Inflation may not be rising the way it was in 2022, but the cumulative damage is still there. Rent is high. Insurance is high. Groceries are high. Credit card balances are high. A lot of households are still looking for value. That is why value-oriented retail matters. On the other side, you have the higher income consumer, the health and wellness consumer, and the premium brand consumer. That part of the economy is not dead, but it is becoming more selective. People are still spending, but they are punishing brands that lose momentum. And then there is the healthcare side. The GLP-1 weight loss drug boom is changing how investors think about healthcare, food, apparel, diabetes management, medical devices, and consumer behavior. Retail investors are no longer just asking, should I buy Eli Lilly? They are asking, what is the second-order trade? That is why this watch list crosses both retail and healthcare. Walmart is the value consumer machine. Costco is the membership quality compounder. Lululemon is the oversold premium rebound setup. Eli Lilly is the GLP-1 king. And Insulet is the smaller, more controversial medical technology name sitting inside the diabetes and drug delivery debate. The ranking criteria today are simple. I am looking at business quality, valuation risk, earnings momentum, consumer exposure, pullback setup, and whether the stock has a clear reason to outperform from here. Not every good company is a good buy at any price. And not every beaten down stock is automatically cheap. Before we start, hit like, subscribe to Stock Pulse, and tell me in the comments which of these 5 you would rank number 1. Now, let's get into stock number 1. Stock number 1 is Walmart, ticker Walmart. Walmart is not the exciting stock on this list, and that is exactly why it matters. When a consumer gets squeezed, Walmart does not need the economy to be perfect. Walmart benefits when households trade down, compare prices more aggressively, and look for convenience without paying premium prices. The business is no longer just a big box retailer. Walmart is becoming an omni-channel grocery, delivery, membership, advertising, and data business. That matters because the market usually gives a higher multiple to retailers that can expand margins through digital and advertising, not just store traffic. The catalyst is the value consumer. If the K-shaped economy keeps widening, Walmart sits on the stronger side of that trade. Lower-income consumers need value. Middle-income consumers want convenience. Higher-income consumers are also showing up at Walmart because the value gap is too obvious to ignore. The key number is Walmart U.S. e-commerce growth. In its Q4 fiscal 2026 results, Walmart said U.S. e-commerce grew 27%, and this was the 8th straight quarter above 20% growth for that segment. That is not normal old retail. That is a major digital shift inside one of America's largest consumer platforms. The risk is valuation. Walmart is no longer priced like a sleepy defensive retailer. The market knows this is a high-quality business. The stock already reflects a lot of optimism around grocery share gains, advertising growth, delivery, and better margins. So the watch list view is this. Walmart is not the highest upside stock here, but it may be the cleanest K-shaped consumer stock on the board. If your priority is stability, execution, and exposure to value-oriented consumption, Walmart deserves a top ranking. But if you're looking for a massive rebound, Walmart may not be the one. Stock number 2 is Costco, ticker COST. Costco might be the best business quality on this entire list. This company is almost unfair. It sells value to consumers, but it does not feel like a low-end retailer. It has loyalty, traffic, trust, private label strength, and a membership model that creates recurring revenue. That is rare. In a K-shaped economy, Costco can serve both sides. Price-sensitive shoppers go there to save money. Higher-income shoppers go there because they trust the value, the quality, and the experience. That is why Costco is not just a retailer. It is a consumer habit. The catalyst is membership power. When people renew memberships at high rates, Costco gets a powerful earnings base. And when those members keep coming into warehouses, the company can drive traffic, sell bulk value, and protect its brand. The key number is sales growth. Costco reported that net sales for its fiscal second quarter of 2026 increased 9.1% to $68.24 billion, and first half net sales increased 8.7% to $134.22 billion. That is strong for a company already operating at massive scale. This one has the best business quality. But there is a problem. The valuation makes it hard to chase. Costco is the kind of stock investors always want to own, but rarely want to buy at the price the market gives them. The company is elite. The brand is elite. The execution is elite. But elite does not mean risk-free. If the market decides to compress high-quality retail multiples, Costco can fall even if the business keeps performing. That is the danger with great companies. They can be great businesses and still be mediocre buys when expectations are too high. So the watch list view is this. Costco is a core quality name. It is probably the best business on this list. But for new money, I would rather buy on a pullback than chase it after strength. Depending on what you prioritize, you could reasonably rank Costco number 1 for quality. But today, quality alone is not enough. Stock number 3 is Lululemon, ticker LULU. This is where the watch list gets more controversial. Lululemon is not Walmart. It is not Costco. This is not a value consumer story. This is a premium consumer story that has been punished hard. And that is exactly why retail investors are watching it again. After the late April weakness, Lululemon re-entered the bottom fishing conversation because the stock had fallen dramatically from its highs. Current market data showed LULU trading at a single-digit price-to-earnings ratio around early May, which is unusual for a brand that used to trade like a premium growth compounder. But cheap-looking stocks can stay cheap. So we need to be honest. The business is still strong globally, but the Americas have become the problem. Lululemon reported full-year fiscal 2025 revenue growth of 5% to $11.1 billion, but America's revenue declined 1% for the year, while international revenue increased 22%. That tells you the story. International growth is still working. The U.S. business is not as clean as it used to be. The catalyst is a sentiment reset. If Lululemon stabilizes U.S. demand, improves product innovation, and proves the brand is not broken, the stock does not need perfection to rebound. It only needs investors to believe the worst-case scenario was too aggressive. The key number is the valuation. This is one of the rare moments where Lululemon looks more like a fallen retail stock than a premium growth name. But the risk is obvious. Premium apparel is brutally competitive. The consumer is selective. Athleisure is crowded. If the U.S. consumer keeps trading down, Lululemon can keep losing attention to cheaper alternatives. This one is exciting, but the business momentum has to improve. The watchlist view is simple. Lululemon is a rebound setup, not a sleep well at night compounder right now. If it works, it can work fast. If it fails, the low multiple may not protect you. This one belongs on the list because the risk-reward has changed after the sell-off, but does not deserve blind confidence yet. Stock number 4 is Eli Lilly, ticker Eli Lilly. This is the biggest, most obvious healthcare name on the list. Eli Lilly is the GLP-1 leader. Mounjaro and Zepbound are not just products. They are market-moving assets. They are changing the obesity market, the diabetes market, and the way investors think about the future of healthcare spending. The catalyst is simple. Demand is still massive. In Q1 2026, Eli Lilly reported revenue growth of 56% to $19.8 billion. Mounjaro revenue increased 125% to $8.7 billion, and Zepbound revenue increased 80% to $4.16 billion. Those numbers are enormous. This is why investors keep coming back to Lilly. It has growth that most mega-cap companies cannot touch. It has a category-defining product cycle. It has pipeline optionality. And it has one of the strongest narratives in the entire market. But this one is also where discipline matters. Eli Lilly is a great company, but the stock is not undiscovered. Everybody knows the GLP-1 story. Wall Street knows it. Retail knows it. Institutions know it. That means the risk is not whether the company is real. The risk is expectation. When a company becomes the obvious winner, the market starts pricing in years of dominance. Any manufacturing issue, pricing pressure, insurance pushback, clinical disappointment, or competition from Novo Nordisk or future obesity drugs can hit the multiple. This one is visionary, but expensive, and that phrase matters. A visionary company can still be a bad entry if the price assumes too much perfection. The watchlist view is this. Eli Lilly is a premium long-term healthcare leader. If you own it with a long horizon, the story is still powerful. But if you're looking for the strongest risk-reward right now, you have to ask whether the easy money has already been made. For me, Lilly is not a stock to ignore, but it is also not the one I would chase without a pullback. Stock number 5 is Insulet, ticker PODED. This is the most misunderstood name on the list. Insulet makes Omnipod, a tubeless insulin delivery system used by people with diabetes. So why is it connected to GLP-1? Because GLP-1 drugs have created a massive debate around the future of diabetes management. If weight loss drugs reduce diabetes progression, improve metabolic health, or reduce insulin dependence for some patients, investors worry about what that means for diabetes device companies. That is the bear case. But the bull case is different. Diabetes is not disappearing. Type 1 diabetes is not solved by weight loss drugs. Device adoption still has room to grow. Automated insulin delivery is still a major category, and Insulet has been executing extremely well. The key number is growth. For full year 2025, Insulet reported revenue of $2.7 billion, up 30.7%, with total Omnipod revenue also around $2.7 billion and up 31.6%. That is strong growth for a medical device company facing a complicated market narrative. The catalyst is re-rating. If the market decides that GLP-1 fears were overdone, Insulet can benefit from multiple expansion and continued Omnipod growth. But this one has the highest debate risk. It is not as simple as GLP-1 is good or GLP-1 is bad. The reality is more complex. Some investors see GLP-1 drugs as a long-term threat to diabetes devices. Others see the entire metabolic health category expanding, with more diagnosis, more monitoring, more treatment, and more technology adoption. That is why PODED is not a casual watchlist name. It is a battleground stock. The watchlist view is this. Insulet has strong long-term optionality, but it is not the safest stock here. It can move aggressively in both directions, especially around earnings, guidance, and any commentary about GLP-1 impact. If you want upside and controversy, this is your name. If you want clean certainty, it is not. Now let's rank all 5. And remember, this is not a ranking of best companies. It is a ranking of risk-reward right now. Number 5, the highest risk and lowest priority, is Insulet. I like the growth. I respect the execution. The Omnipod numbers are strong. But the stock sits inside a complicated healthcare debate, and the GLP-1 overhang is not going away. This one has upside, but it also has the most narrative risk on the list. Number 4 is Eli Lilly. This may sound strange because Lilly is one of the strongest healthcare companies in the world. But that is exactly the point. The business is incredible. The GLP-1 numbers are incredible. The product cycle is incredible. The valuation and expectations are the issue. This one is visionary, but expensive. I would rather buy panic than chase euphoria. Number 3 is Lululemon. This is the rebound candidate. The stock has been crushed. The valuation has compressed. The brand still has global strength. But the America's weakness is real, and premium retail can be dangerous in a K-shaped economy. LULU could have major upside if sentiment turns, but still needs proof. Number 2 is Costco. This one has the best business quality. The membership model, the trust, the traffic, the value proposition, and the execution are all elite. But the valuation makes it hard to rank number 1 for fresh money. Costco is a stock I want to own at the right price. I just do not want to pretend price does not matter. And number 1, the strongest risk reward on the list right now, is Walmart. Not because it is the flashiest, not because it has the highest upside, but because it has the cleanest connection to the current consumer economy. If the consumer stays pressured, Walmart benefits. If e-commerce keeps scaling, Walmart benefits. If advertising and membership fees keep growing, Walmart benefits. If households keep trading down, Walmart benefits. This is the strongest risk reward on the list right now because the business is defensive, but the digital transformation still gives it growth. Here is the honest bottom line. Not every stock on this list is a buy today. Costco is a world-class company, but I would prefer a pullback. Eli Lilly is a healthcare powerhouse, but expectations are extremely high. Insulet has real growth, but also real controversy. Lululemon has rebound potential, but the brand needs to prove U.S. momentum can stabilize. Walmart is not cheap in the old-school sense, but it has the clearest setup for this market. That is the point of a real watch list. Every stock on this list plays a different role. Walmart is the value consumer compounder. Costco is the best quality membership machine. Lululemon is the oversold premium rebound. Eli Lilly is the GLP-1 mega cap leader. Insulet is the speculative healthcare optionality play, not financial advice. Do your own research. Size matters. Risk management matters. And never buy a stock just because it appears on a watch list. But if I had to rank the 5 today, my order would be number 5, Insulet. Number 4, Eli Lilly. Number 3, Lululemon. Number 2, Costco. And number 1, Walmart. Now I want to hear from you. Which stock would you rank number 1? Would you go with Walmart for risk-reward, Costco for quality, Lululemon for rebound potential, Eli Lilly for GLP-1 dominance, or Insulet for speculative upside? Drop your ranking in the comments. And if you want more practical watch lists like this, subscribe to Stock Breakout, hit the like button, and I'll see you in the next video.